Hi, friends. Walt here with the Schultz team at Canopy Mortgage. I've got a lot to talk to you about today, and I want to cover it very, very quickly. So run with me as we look at this. I'm going to try to take you behind the scenes of how mortgage rates are created and the importance. My main topic today is going to be on loan level price adjustments. It's all the rave in the media. I think that the media has made it to be a lot more negative than it really is. And I've also seen a lot of lenders out there, mortgage people really just kind of sweeping this under the rug and saying really nothing to see here, nothing to see here. So today I wanted to delve into the numbers behind this. I'm going to tell you that it's not all positive. There is a little bit of negativity. And I think that really that negativity stems from fear and that. And let me explain. Behind every mortgage, there's going to be a strategy. And I think today's economy, today's mortgage is more about strategy than it is about rate. I will explain here in a little bit. So working really with a lender that's going to go through strategy with you more so than rate with you is going to be more important. In fact, I will show you how these changes can actually help you pay your house off in about 8 years faster than what it might have been in the past. So let's first walk through rates and how we create rates. Now, when we get rates, I get calls all the time asking, what is your rate? And the reality is that we as lenders don't get one rate, but we get a rate stack. Now, today, the rate stack for a 5% down, 780 credit score is going to be between 4.99% and 7.625%. So what rate do you want? It all depends upon your strategy. What is the most strategy? Now at 7.625%, we're actually going to pay you $2,200 for that loan. You ask why? Well, because we're going to pay you when we sell the loan to the investor is going to pay us $2,200 more than our agreed upon price. And so therefore, we're going to pay that money back to you. You'll see it's 7.375. There's a little cost, $521 cost. So that really becomes more of a kind of a no point loan between 7.5 and 7.375. As we start to walk through, because rates are significantly higher right now than they have been in the past, we'll have a tendency to go down to 1 point. So at 6.5%, you'll see here that the cost on that is 1.055%. So remember that number because I'm going to reference that number quite a bit. So it's 1.055% at a 6.5% rate. Again, you can go all the way down to 4.99% if you want, and it's going to cost $27,000 for that loan for that rate, which in most instances doesn't make sense. So let's talk about loan level price adjustments and what they are. I liken loan level price adjustments unto a thumbprint. If you take away our actual fingerprints on our thumb, we have just skin there, right? Kind of a little gross if you think about it, but we just have skin there. Now you add the actual fingerprints, and that's how rates are derived, meaning we all have a base rate. We all have a base thumbprint. From there, when you add the fingerprints, all of us have a variation of the same base, but they're all different. We all have different fingerprints. And so those fingerprints are the loan level price adjustments. So for instance, people come in and they say, hey, I'm going to put 20% down. I'm going to get the best possible rate, right? Well, the reality is no. If in today's market before May 1st, if you put 20% down, your fingerprint or your loan level price adjustment is actually going to be 0.375%. So if we go to that same scenario where let's say it's a $100,000 loan for quick math for me, and the cost for a 6.5% rate was 1%. Let's not add the extra 0.055, but just 1%. Well, now the new cost is going to be 1.375% for you for that rate. So we have the choice of staying at the 6.5 and charging you the 1.375% or dropping the rate down to maybe 6.625 or 6.75. And that's how rates are derived. We're going to be all over the board there. And so what are your loan level price adjustments? If you're putting 20% down and you have an interest rate or a credit score of 700, well, it's going to cost roughly 1.375%. and so on and so forth. So the reason why I share that is because the new loan level price adjustments that are coming up May 1st, here are the additional hits or subtractions. If we have, if you're putting 3 or 5% down, you're golden. So not a problem across all areas of credit scores. It doesn't matter. You're actually going to get a little bit better rate. You're going to get a little bit better fee for that rate. So again, if you're talking that $100,000 loan and it costs at 6.5%, it's costing 1% right now. Well, it's going to cost actually 3.375%. And so therefore, it's going to cost $375. So do you keep that rate, or do you maybe go to 6.375 or 6.25? So where do you go with that? Now, if you're putting 10% down or more, then if your credit score is at 780 or above, you're going to be fine. However, if you're a little bit lower at 760 all the way down to 680, then you're going to pay a little bit more of a premium. So that's where the hurt can come in. If you're at 720 to 759, you're going to pay the most significant premium. It's going to be a hit of 0.75%. So again, if you're at $100,000 loan amount, that's going to cost you an extra $750 to keep the same rate. Now, that's the bad news. The good news is this. As we walk through, let's start to walk through the different changes here on an actual basis. At a 760 credit score, your rate yesterday was 6.625. And the increase in rate after May 1st would be 6.875. That is if the market stayed the same, and it's already changed. So, but ultimately, I just want to show you kind of apples to apples. If it was yesterday's rate and the market stayed the same to May 1st, then you would be at 6.625 today. On May 1st, you'd be at 6.875. It would cost you $1,000 to get the same rate as it would have. So it either cost you $1,000 or you take the higher rate. If you take the higher rate, it's going to be a deduction of around $12,000 in purchase price. So whatever path you want to follow. And this would be if you're putting 10% down. So a 760 score, putting 10% down. Now, if we're at 740, we would be, this again was yesterday's rates, would be at a 7% rate. Your rate changes to 7.5% after May 1st. 7.5%, if you take that in buying power, it's going to be about a $15,000 deduction in buying power. That's where you've got to watch. You've got to talk to your lender. You got to strategize, look at your strategy. So what are we going to do? Now, what I would propose is, if you can do it, and if it makes sense on a monthly basis, and if you qualify, instead of putting 15% down across the board here, change to where you put 5% down. Remember the slide that I showed you where everything at 3 and 5%, you actually get a benefit to the rate. So let's then take that benefit and let's get that 7% rate back. Let's then get that 7% rate back. And here's the really cool thing, guys. Let's take that money and invest it with a financial planner, $50,000 at a 7% return over 15 years is $142,000. Check this out. If you take that and if you continue it to 21.92 years, you will actually have enough in your account to where you can physically write a check and pay your mortgage off. So you just shed 8 years off your mortgage. That is massive. That is absolutely massive. So that's how we can start to use these loan level price adjustments to our benefit, when one, it may be a negative at first, but let's restructure, let's re-strategize and use it to our benefit. Super exciting. Now let's look at a 700 score. So those people, and this is where really that change in the loan level price adjustments, they wanted to help people with lower credit scores to be able to purchase more home, to make things a little more affordable. Now, and I'll talk again about affordability here in a minute, but here we're looking at a 700 score. Your rate is 7.125. It would drop to 6.875. You actually get a little bit better. It's gonna help you save a little bit more money, and it increases your buying power by roughly $512. I'm sorry, by 12,000, which then increases your buying power to around 512. So again, it's now helping people purchase a little more home, and it really saves. It can save money on a monthly basis. Now we go down to a 630 score. Historically on a 630 score, really historically anything on a 700 score and below, we would go to FHA. And that really is not the case now. As I started to look at FHA and conventional loan pricing yesterday, the non-benefit to FHA is that there's a 1.75% funding fee that's charged on top of your loan amount. So again, if you're at a $100,000 loan, in order to use FHA, you're going to have to finance an extra $1,750 finance on top of your loan amount. And so FHA a lot of times isn't really a good bet because of that, but also FHA has mortgage insurance the whole life of the loan. So if we can stay conventional, that's going to be a better route and a better path. And this gives us that ability to be able to stay conventional with a better route and better path. So let's look at here, if we were to go with a 630 purchase price, your rate would be 6.75 today. After May 1st, your rate's actually going to drop a full 1.125% down to 6.5%. 6.5%, that gives you the ability to be able to purchase an additional $60,000 for a total of $560,000 to keep the same payment that you would have before. Massive significance, massive significance. Now, here's where the fun begins. So it helps with affordability. It helps people to be able to get into more home. And we can strategize on how we can get your loan paid off faster. That's again why it's so important to work with mortgage strategists. So here, if we're looking at 630, the payment difference between where the rate was 7.625 and 6.5 now is $359 a month. That's what helps you get to that 560 loan amount. That extra $359 helps you get that extra $60,000 in purchase price. But let's say that you don't buy an extra $60,000 house. Let's say that you take that investment on a monthly basis and try to and you put it towards your mortgage every month instead. Put it towards your mortgage and try to pay your mortgage down faster. You're actually going to pay your mortgage off in 22.42 years. So again, saving significant time on your mortgage, around 7.5 years. 7.5 years at a payment of $3,002 is a significant savings. Now, let's say that you're worried about retirement because 78% of Americans lose sleep over retirement. If you're losing sleep over retirement, take that $359 a month and invest it with a financial planner over 30 years. Over 30 years, you pay your house off and you have an extra $438,000. $438,000 in retirement. I think then if you had that, I think you would not lose sleep over retirement. So friends, we can make this negative if we want. The reality is that it's really not negative. The media will make it to be. The media is going to make you think that the sky's falling, and it really is not. This again brings forth the point that working with a mortgage strategist is more important than ever. Working with somebody who's going to look at a holistic approach, look at your finances, and look at how this could benefit you is more important than ever. Somebody who's going to swipe this under the rug, you really don't want to work with, because it's just going to be the same old for them. But for us and our team, we look at this in a holistic approach, and we want to help you not only get in debt, but help you get out of debt sooner rather than later, and help you create wealth through your mortgage. So if this resonates with you, please give us a call. We would love to work with you. We would love to help you strategize on your mortgage. Thanks, guys. Have a great day. We'll see you soon.